Welcome to Part 2 of College-Bound Student Loan Training. If you've not yet completed the introduction in Part 1 of this series, please follow the links below. Part 2 will discuss loan repayment processes and plans for federal and scholarship foundation loans. If you need to review these types of loans, please view Slide 4 on the introduction slideshow, which provides additional resources to help you navigate this content. The link to the presentation is below in the comments. To start out, let's briefly discuss some goals a borrower should have to ensure they successfully repay their student loans. A student should take the time to know who their servicer is by creating and keeping up to date their online portal, including contact information, tax forms, and applications. They should also reach out to their servicer should any financial difficulties arise, as the servicer has a responsibility to help keep its borrowers out of delinquency and default. Self-advocacy is a key in the student's relationship with their servicer. Further, a student should take the time to plan and borrow responsibly. At College Bound, we have several checkpoints at which students will go through their financial plans to ensure they are being responsible borrowers. However, if a student comes to you with concerns outside of these checkpoints, definitely address their concerns and reinforce the information provided in those sessions. Now that we have an idea of a student's goals for repayment, let's talk about Scholarship Foundation. It's the most straightforward. Any student who has Scholarship Foundation loans should expect to get a letter from the organization a year after they have graduated, when repayment begins. In general, the student should expect to make monthly payments for 5 years total, and they can determine what their payment will look like simply by dividing their loan debt by 60. If a borrower feels they cannot make this payment, they have the option to complete the repayment assessment form, which may decrease what they owe by 50%. If the student is in a financial hardship, they may also complete this form to request deferment. Either way, it's a good idea to keep in mind that a borrower may only receive this reduction in payment for 3 years total in their loan term. This is an important topic when discussing financial plans with students. Next, let's take a look at the different federal repayment plans. Here, you can see the most basic plan types: standard, graduated, and extended. These plans don't require applications, and a borrower can switch between them as often as they like by contacting their servicer. Of course, keeping the process consistent is very important, so it's a good idea for the student to plan their finances out first so that they can pick a plan that works for them and stick to it long term. There are a few differences between these plans. First, the standard plan will allow a borrower to make the same monthly payment over a 10-year period, but the graduated plan starts out with a lower monthly payment and increases over the 10-year repayment period. Generally, this increase in payment takes place on an annual basis, depending on the amount of debt a student has. Further, the standard and graduated plans will allow a borrower to repay all of their loans in 10 years, but the extended repayment increases that period to 25 years, thereby extending the interest built as well. An extended plan can either be standard or graduated in nature. In order to qualify for an extended payment, a borrower must have at least $30,000 in federal direct loan debt. Remember, this does not include Perkins loans. This must be $30,000 in federal direct, subsidized or unsubsidized loans. Students also have the option of applying for plans that assign monthly payments based on the student's household income levels. These plans are called income-driven repayment and have some additional requirements for enrollment. First, a borrower must apply and submit documentation of their household income for the past year. Once they submit this documentation, their servicer will calculate a monthly payment. The amount of that payment will be a certain percentage of the student's discretionary income, which is calculated from the tax provided. There are actually several different versions of these income-driven repayment plans. There are tiny differences between them, so the details can be much better discussed with a loan servicer or financial aid administrator. I have simplified the characteristics of the plans on this slide here so that it's easier to explain to students. If you're interested in more information, please visit www.studentaid.ed.gov for details. Please avoid placing any value on any plan unless you have a deeper understanding of these processes. Now, there are two main types of this income-driven repayment: pay-as-you-earn and income-based. To summarize them, both plans assign payments based on a student's discretionary income. Both may assign payments as low as $0. Both offer forgiveness plans after a certain number of years, and both have the potential to increase a student's tax liability. Let me make a quick aside. Tax liability is the amount of income tax you're expected to pay. The more student debt the federal government forgives, the higher the borrower's taxes for that year. This is very important to keep in mind as you're discussing these plans with students, because at the end, when amounts are forgiven, they will or could possibly have implications on their taxes due. The newest of these plans is the Pay-as-you-earn repayment plan, which was implemented by the Obama administration, and it provides the opportunity for the lowest monthly payment for a student. This plan is suggested for use with the Federal Loan Forgiveness Program. If a student is interested in exploring what enrollment would look like for either plan, they should use the loan repayment calculator on studentloans.gov or contact their servicer. Another option for borrowers in repayment is deferment and forbearance. Each of these programs provides a borrower with the ability to make no payments for a specific period of time. As with income-driven plans, these two options have many different versions, and a borrower may be eligible for all or none of them depending on their circumstances. A borrower should contact their servicer to discuss these options if they find themselves in a situation where they cannot make monthly payments, and the servicer can direct them to the correct application. Make sure to point out to students, though, that the servicer may ask them very personal questions to help direct them. They're trying to make sure that a borrower meets qualifications so they don't submit multiple applications, not trying to be nosy. It can be very helpful to go ahead and tell students this beforehand, and it can make that conversation go a lot more smoothly. There is one main difference between deferment and forbearance. In deferment, the federal government subsidizes the interest on a student's subsidized loan debt. In other words, interest will only accrue on the student's unsubsidized loans. Deferment is generally harder to qualify for and may require more paperwork, but it is the better choice if a student is eligible. Loan forgiveness is another option that students can consider when planning for repayment. There are many types of loan forgiveness in private business, but because they are not consistent, we're going to stick to discussing federal forgiveness options. One main option is public service loan forgiveness. This federal program allows a borrower to have all debt forgiven after 10 years of service in the nonprofit sector. This can mean a job in higher education, public or private nonprofit, or even government. A student will have to submit an application for enrollment and will then need to reapply every single year to ensure that maximum amounts of their loan are forgiven. It's imperative that a borrower enroll in an eligible repayment plan, like Pay-as-you-earn, in order to take advantage of the forgiveness. The great news about this is that the amount forgiven does not increase a borrower's tax liability. Another type of forgiveness is for elementary and secondary education, teacher loan forgiveness. A borrower who works full-time in an eligible under-resourced school district for 5 years may have all or a portion of their debt forgiven. As with public service loan forgiveness, a student must apply and enroll, then reapply annually to be eligible. The amount forgiven, like with PSLF, does not increase a borrower's tax liability. Lastly, we're going to talk about a slightly different form of forgiveness, AmeriCorps service grants. Any borrower who successfully completes 1 year of service with AmeriCorps will receive a Siegel Education Award, which can be used either for future educational expenses or to pay off past loans. Unlike with public service loan forgiveness and teacher loan forgiveness, the AmeriCorps grants do increase a borrower's tax liability. So it's important for a student to consider implications when deciding whether to seek out this type of forgiveness. These conversations and understanding of this type of grant is becoming more and more important as more students are choosing to go into service post-graduation. If you're a staff member rather than an AmeriCorps volunteer working with College Bound, make sure to seek out the coordinator at the organization to get clarification if you're not sure how the process works. Before we close this session, I want to include a brief reflection on these forgiveness programs. As you counsel students, it's a good idea to remind them that none of these plans are fail-safe. Although the government is making great strides to ensure that these forgiveness programs are available, budgets are limited and they change often, so students should make sure all debt accrual is necessary and have a backup plan just in case. These are the resources that we use for this session. Please feel free to follow links at the bottom, and we look forward to seeing you in part 3.